Well, hello everyone, and welcome to this week's edition of HECMWorld Weekly. Glad to have you here with us. Let's jump into our first story, which strangely has some good advice for reverse mortgage professionals coming from Ramsey Solutions. We found this on Yahoo Finance. On a recent episode of The Ramsey Show, a caller named Wendy revealed a heartbreaking scenario, and that is that her own sister had systematically drained her parents' finances. And she recounted how the sister had maxed out credit cards, emptied bank accounts, and even consumed $450,000 from reverse mortgage proceeds. Of course, during this whole debacle, the parents were trusting this thieving daughter, which really brings us to how can we help prevent elder financial abuse? According to data from the National Council on Aging, nearly 47% of reported cases of elder abuse originate from family members. And the research also suggests, outside of that study, that family members are in fact responsible for the majority of elder abuse cases. I tend to lean that direction a little bit more. And when fraud begins at home, it's especially insidious because the elderly victim is often embarrassed, confused, ashamed, and has very, mixed feelings about reporting a family member. Financial elder abuse is often, invisible if that, and often is unreported or uncompensated. So Wendy's story is a stark reminder for you as a reverse mortgage professional to be vigilant for any family member, adult child, or any other relative involved in the transaction, or maybe even a family friend who is pressuring that homeowner to get a reverse mortgage. If you sense that, you really want to have your feelers up and be aware and get someone involved if you need to. Yes, we even had a lesson from Ramsey Solutions, believe it or not. There's a new technology partnership in the reverse mortgage space. On September 30th, a press release announced that Atlas Valuation, or Atlas VMS, is partnering with QuantumReverse, which is our industry's leading LOS, or loan origination software platform. And they're using Aimport management platform. And that partnership will allow reverse mortgage lenders using QuantumReverse basically to directly plug into Atlas's AMC operation and order their appraisals. And that's really a game changer. It saves a lot of time. Aimport is a next-generation appraisal technology platform designed to streamline the appraisal ordering process, compliance, and oversight. Atlas acquired Aimport in early 2025, and it connects lenders with their approved appraisal management companies, and it gives them an efficient way to manage that process. Aimport essentially centralizes the appraisal management ordering and process and oversight throughout all of the approved AMCs in the nation, and the arrangement with QuantumReverse really underscores how both companies are committed to having innovation in the reverse mortgage space. In fact, it's much needed. Thomas Martignoni, who is the founder of QuantumReverse, said, "The partnership represents a major step forward in streamlining the appraisal process for reverse mortgage lenders." Adding, by embedding appraisal ordering and management directly within the LOS, we are eliminating error-prone manual steps, improving efficiency, and reducing turnaround times from our lender partners. Eric Marin, who is the CEO of Atlas Reverse, said integrating Aimport into QuantumReverse reflects our shared vision of bringing modern, scalable technology solutions to an industry that has long needed them. Chrisman Commentary is a daily news source. It comes across as an email newsletter for mortgage professionals across the country. I've been subscribing myself for many years, and last week I came across a very interesting story. Jesse Allen, who is the president of retail reverse mortgage operations at Rate, was featured in last Wednesday's Chrisman Commentary. So today I'm going to summarize the Chrisman write-up and also a recap of Brian View's podcast interview with Jesse Allen. In the podcast summary, Allen notes that many have overlooked the active adult homeowner segment, and that is those 55 and older, despite the fact that they control a tremendous amount of housing wealth here in the U.S. and have unmet financial needs. So rather than chasing new prospects, what Allen suggests is that originators should be viewing reverse mortgages as a value add for existing mortgage customers and help clients unlock equity without the burden of monthly principal and interest payments in retirement. One concept that Alan finds especially powerful is the HECM, or reverse for purchase, which basically allows a client to sell one home and downsize or right size, and it combines the features of a traditional mortgage and a reverse component. For example, a borrower could put down 60% and eliminate future required monthly principal and interest payments by financing the balance with the HECM for purchase, and then they still have the funds to cover property taxes and homeowners insurance. He also emphasizes that there is a mind shift in this approach in meeting the 55 plus market. And he says to make that work, loan officers should be segmenting or dividing their database to flag 55 plus clients and then prepare them when they become eligible for a reverse mortgage. Some of them may actually be eligible for a proprietary reverse mortgage, but you can accomplish that mission through financial seminars, about aging in place or workshops, partnering with referral sources such as CPAs and financial advisors. The goal, says Alan, is to be that go-to advisor, the trusted advisor in the area, and that can really participate and inject themselves into the client's life cycle of their mortgage, not just during their first mortgage. So this speaks to engaging with traditional mortgage professionals and helping them see the opportunity in the reverse sphere. So that's the gist. Basically, Alan is saying that reverse mortgages are no longer just a niche product. We may feel that way with our low endorsement volumes, but it really is, in fact, a strategic means for mortgage professionals to help their clients throughout their years, not just their working years, but their retirement years. So I would encourage you to check out the full Chrisman Commentary article and also explore the podcast. We're going to have links for those in the show notes, which you can find on this episode at HECMWorld.com. Last week, as you know, we released the most recent edition of the HECMWorld Top 100 Retail HECM Lenders Report, and it was also the last month of recorded endorsements for fiscal year 2025. So I'm going to give you my take and some interesting observations about that fiscal year in our endorsement performance. So we closed out September, the last month of the fiscal year, with 2,211 direct retail HECM endorsements, and that's slightly better actually than September 2024. And during the last fiscal year, we saw a monthly average of about 2,348 endorsements. Now, month-to-month gains, they actually outnumbered losses in 2025, 7-5 as well. Another interesting point is that fiscal year 2025 was the first year that we saw year-over-year growth since 2022. And that's because we had a real retraction after interest rates went up. We had that sugar high of the low interest rates and HECM to HECM refinances. For example, we saw growth in the pandemic years. In 2021, HECM endorsements were up 34%. Then they increased another 31% in 2022, but then the Fed had already raised rates. The 10-year constant maturity rate had already gone up significantly. Well, then endorsements fell by 49% in fiscal year 2023 and by another 20% in 2024. So at least having a 6% year-over-year gain is a positive development, but it just shows how compressed our volumes became once we were out of that refinance boom. In reviewing the latest HECM data, our HECMWorld analyst, James Veal, noted that despite the Federal Reserve cutting rates that totaled 100 basis points, that was between July and December of 2024, long-term treasuries didn't follow as they often do. What you see is that the Fed funds rate and the 10-year treasuries typically will correlate or nearly match each other's movements, but that doesn't always happen. In fact, the rate went up during that same period when the Fed was making those rate cuts. And that surge in interest rates likely suppressed endorsement volumes in the first 3 to 4 months of fiscal year 2025. Another interesting point is that the number of active retail HECM lenders, that is, a lender that posted at least one endorsement in a given month, fell from a high of 106 in December of 2024 down to 84 in August. And May was the one exception, however. We had 98 active HECM lenders then. But just last month, in September, there were 14 more HECM lenders that had at least one endorsement. So that's a move in the right direction. Now, strangely, we have not seen any update in FHA case numbers from the single-family portfolio. That report is really behind, but strangely, we just saw a sudden glut of new reports being posted for the HECM snapshot. So we're up through September of 2025. That kind of breaks down the characteristics of the HECM loans, whether they were refinances, first times, or purchase transactions. However, I must say there's one metric that we just simply cannot report on, and that is the number of proprietary or private reverse mortgages that were funded in the same fiscal year. Now, we can speculate just how much proprietary operations have trimmed back HECM endorsements, but to do so without solid data would be mere speculation.